Banks tell us to do things that actually they do the opposite of.
Welcome back, investor, to another episode of the Passive Income Adventures. If this is your first time listening to the show, it's a show about where we peel back the curtains on the whole passive income journey and just try and cut through the BS to get to the real story about how you're going to get passive income so that you can have more time and more money to basically design the lifestyle that you want to live. It's not about private jets and about sitting on beaches. It's about crafting the lifestyle through doing the work upfront so that you can enjoy all of the results on the back end. So today we got Dominique Henderson, a certified financial planner and wealth management specialist. I think does the WMS have its own certification? Is that like a real thing?
That aren't even like him. I don't even want her certification.
Certified financial planner, calling it from Dallas, Texas. And we just moved away from Dallas, Texas. So unfortunately, we didn't get to meet up when we were living there. But thanks for being on the show. And you are going to teach us today about the tips and tricks that rich people and their advisors use to help them basically get to the point where their money's working for them and they're not working for money. And you have some pretty unique tools that you use to do that. And I'm excited to learn about it because even though we use some of the tools, I wasn't the specialist who set it up. And so I've forgotten the details. And sometimes I feel like I need to go back for a refresher because I'm not even sure if I'm using it correctly anymore. So thanks so much for coming on.
Yeah, absolutely. Thank you for the invite. Thank you for responding on LinkedIn to my DM. That's a thing. People don't respond to DMs all the time. Definitely appreciate all that. And I'm happy to lock in for this journey. And hopefully your audience will get some value out of this conversation.
Yeah. I think you just made a really good point. Like that right there. Like I don't respond to a lot of DMs in LinkedIn. And so the fact that you had an authentically crafted message, I don't know if you copied and pasted it to a bunch of different people, but the way that it read looked like you were talking to me and it had direct value where you weren't trying to necessarily pitch me a service. You more wanted to have a conversation about some of the techniques you use. Asked about the pod. I'm going to respond to authenticity. And so I try to be authentic when I'm on LinkedIn. So that's tip number one for the listener. Like you did it right.
And just so people know, I looked at your profile. I forgot whose thread I found you on or whatever, but I looked at your profile. I read through it. I clicked off of LinkedIn and went to your podcast and listened to about 5 minutes of it on 2x speed and go, that might be an interesting meetup digitally. So let me just see what she says. What are you doing? It literally took 3 minutes. Not too much of my time. It was worth it.
And it's a much more authentic connection than sending out a wall of text and a cold pitch that we just ignore. I delete it, move it to other, whatever. I just ignore it. So if you're not there to offer value, and I always say, usually for the end of the show, I say this part. The network is what makes this whole industry go around. How to genuinely connect with people. Volume, it's super time consuming, but it's a special skill and it's so important. We don't get anything done in this industry without good networking.
Now, there's a good LinkedIn masterclass for people that were, or any platform, social platform.
LinkedIn masterclass you didn't know you wanted, but you got when you tuned in. So people are like, get to the point already. All right, Dominique, take it away. Introduce yourself. Give us your background. Why should people listen to you? And I really enjoyed the story when we had our preview call about how you've discovered some of these tools and the way that I feel about real estate or personal finance. Like I didn't learn any of this in school. I have a business degree in entrepreneurial studies, like specifically for entrepreneurship. And I don't feel like I even learned how to do my own bookkeeping or even manage a bookkeeper. There are just so many things you don't learn about in school. You don't learn anything about real estate. And I have had to be self-taught on a lot of this. So even though you have the educational background, the certifications, you still felt like, oh, I've been wronged. So tell us about that.
Yeah. As we stand here in 2024, I graduated from Prairie View A&M University in 1998. So I immediately started working for a hedge fund. 8 years in, I got a little bored. Don't want to tell you about our whole story. I got a little bored and I left. And probably around that time, about 2006, if you're keeping up, a lot of the Flip That House, A&E, Discovery Channel was like a big thing. So I was like real estate, I'll do that. That's what I want to do. So I did that for about 18 months. And if you're just following along the timeline, it's 2006, 18 months puts me in early 2008. And we all know what happened in 2008. So my timing was a little off on my real estate journey. Just so people know, I have my scars and my wounds from some bad real estate deals. There's some good ones too. But I say that to say this. That journey, let's call it up into 2008, 2009, led me to be reinvigorated. I started in financial services. I wanted to get back to financial services. There was a reason that I started that path. And then I was like, maybe I need to do more client facing stuff. So I've been client facing ever since 2008, 2009, with my own firm and all the things. And I'm just going along, serving my clients, wanting to give what I call real financial advice, real relatable, empathetic, attentive listening. And I'm like, I have all these mantras that I'm going through. It's going well. It's going fine. Then almost 3 years ago, I'm headed to Austin to visit my daughters. And on the way down, don't ask me how I got this book on my Audible list. I do not know to this day, but I listened to R. Nelson Nash's Becoming Your Own Banker. And I'm just driving along listening. I'm like, this is pretty interesting. Surely not. And while I'm there visiting my girls, I'm done with the book, but he references, I believe in that book, Robert, Laura, and Murphy, these two guys that talk about how banking really works, how the banking system really works. And I binge watched or binge listened to about, I don't know, 20 of their podcast episodes while I was down there. And I was just like, this is interesting stuff. Listen to the book on the way back to Dallas again. So I'm hooked. And I was like, the first thought that came to my mind to your first question is, how the heck have I been in 20 plus years in financial services, CFP, master's degree in finance, undergrad in finance, all the things, and never heard of this? Like, what is going on? And we're going to talk about what this is, but I am really scratching my head. So I'm calling colleagues. Hey, dude, have you heard of it? And they're like, oh, man, that's a scam, all the things. And I'm like, nah, man, it's not a scam. I didn't just invest it. I was just listening. It's not a scam. There's something to this. And what I began to find out, Emma, is that very few people in the industry, and I have to give numbers on this stuff because I study this all the time, know about this, right? There's probably 600,000 people per the Bureau of Labor Statistics calling themselves financial professionals. Mm-hmm. A large degree of them obviously are like the insurance and stuff like that. And a lot of these people did not know what I was talking about.
Yeah.
It just didn't. And an insurance marketing agency that I use to sell insurance products to, when I went to them, and they've been doing this for years here in Dallas, they didn't know what I was talking about. So I was like, whoa, this is groundbreaking. I'm treading lightly, but let's speed that part up a little bit. 8 books later and 2 coaches later, I'm writing my first policy on how to create my own family bank. And so that was the it. And since then, and we can double click on any of these you want. Since then, what I've decided is I had been missing a very significant bucket that the wealthy and the rich have been using for literally like decades to preserve their wealth and escape overtaxation. We can get into that too. But we all need the demand deposits. We all need to be able to go to the bank, swipe the debit card, however you do it. We all need to be able to access markets through brokerage accounts, S&P 500, access to that kind of stuff. We all need a family bank.
Yeah.
And the family bank is for really one reason. You're going to need capital throughout your life. You're either using yours or using somebody else's. So you got to have a way to finance this. And so that's why it's so important. That is the main reason why this is so important. And that's the way I use this as a philosophy. I know there's a lot of people that just come in and say, cash flow system, use it to pay off debt. There's a lot of terms around this. Infinite banking, high liquidity banking, private. There's a lot of terms. But basically, I'm using this for a way to finance your life using someone else's money.
Mm-hmm. Okay. So it's such a good question because I remember I have a distinct memory of the first time I heard about this. It was on YouTube, and I think the reason it has a reputation for being scammy is a lot of scammy people are talking about it. It ruins the credibility of the whole thing. And the policies come with high commissions. And so there's the ulterior motive that I want to sell you something you don't need because I'm going to get high commissions. So once I got over the fact that the guy who was talking about it might not exactly be reputable, I started going down the rabbit hole to find more people who seemed more reputable and didn't have a dog in the fight on the commission side. And I had to strip away some of that doubt and really go down that rabbit hole to see, is this the real thing? But when I first heard about it, I was on my laptop at my sister-in-law's house, and we had just moved from Austin to Salt Lake City, and I didn't have a job anymore. I left my business behind, and we'd sold a house, and so we had some cash we were sitting on. I was just trying to figure out, okay, now I'm an investor. I have enough money that I can go do something, and was just immersed in personal education, financial education, real estate education, just really trying to figure this out. And my mouth just dropped open sitting there and, oh, what, like, why have I never heard of this? Why is everybody telling me that cash value life insurance is a bad deal and you should just get term and all this kind of stuff like we've all heard? And he kept talking, and I finally shut the laptop, and I went and found my husband, who was sitting on the sofa chatting with his sister. And I'm like, I don't care what y'all are talking about. I need you to watch this. And I opened it up, and they were just not blown away the way that I was blown away. But at that point, I was like, fine, you can keep talking about sports or whatever you guys are talking about. I'm going to go research this. And I spent the next probably couple of weeks really, like, your experience, very similar to mine. Like, what? It ended up being a useful tool in my toolbox, but it has to be like an entire suite of strategies. So I totally get that. So can you talk to me about why most financial planners or personal finance people either have never heard of this, or if they have heard of it, they just automatically, oh no, that's a scam? Because I'll tell you now, a couple policies later, it's not a scam. We use it and it works for us. So we get into some of those stories later, but why do you think that it has that initial reaction to people? I've had people, and I told them about it the first time, they're like, that's not Matt.
Yeah, I think in a word, conditioning. We as humans we're a lot more susceptible to subliminal messaging than we think.
Okay.
I was talking to an audience this morning, and just what we feed our subconscious is so much stronger than what's actually, in our conscious brain. And I was like, I'm dating myself a little bit. I don't even drink this stuff, but most people would know that the best part of waking up.
Yes.
It's just deep in my subconscious without me even like wanting it to be there. And it bubbles up, and I got to make a choice on how to use it. So I think that's a very apropos lesson to this, because when you hear people like a Dave Ramsey, 5 days a week on your way home while you're working a job for 5 years, and he says cash value life insurance is the devil, it just gets there. Now, practically speaking, and we can go down this rabbit hole if you want to, Dave Ramsey, I bet you.
I know, and he has one. I know.
Cash value life insurance.
It's like this.
He has it.
He has
one. He's a millionaire multiple times over. He's going to have an estate tax, and he doesn't want to write a check. He doesn't want to self-fund his estate tax. I bet you.
Almost every millionaire I know, and now that I have changed my whole network, we moved and changed my business and everything. I know a lot more millionaires now than I did before, like multi-millionaires. I know a lot of people with $1 million net worth. It's not that big of a deal anymore, but it's 2 million and up, right? Almost all of them have one of these policies, and we can't have all been sold up the river.
There's a lot of commissioning. So what people don't know, and this is just things to know for your audience, the rate at which term life pays out is something like less than 5%, meaning that 95% of people that buy a term policy, it's just like auto insurance. You just pay it. You never use it.
It expires before you need it.
So if you did think about it, and I hate to give conspiracy theory on stuff, but like you're bringing out the juicy digit. So thank you.
I've heard this before.
What happens is the premiums come in and they sit in there's a part that covers your death. It's called mortality and expense, and it's based on, it's just math. It's actuarial tables. This is the reason why they don't let cancer patients come in. It's just like the average length of life for X individual that's this years old, male or female. That's all they use.
Yeah.
Tables get updated maybe every 30 years or something like that. But the point is, a portion of your policy premium or a portion of your premium payment goes to that. The rest, depending on the structure of the policy, let's stay with term right now. The rest pretty much goes to commission, right? And with that leftover admin expense for commission and all the things, we got a lot of money that's sitting in the coffers of the insurance company. And they get to use that money to go invest in things. They do it all the time.
Yeah.
Berkshire Hathaway does this this is why Warren Buffett has billions of dollars on his balance sheet, because he basically controls an insurance company and he controls the money.
We have commercial loans on our multifamily properties from insurance companies, and they give amazing rates and terms. If you can get in with an insurance company to give you a mortgage, they're fantastic products. So they got a lot of money that they're investing with my money. So why is that a good thing for me? Why is that a good thing for me? Because if they're taking my money and they're investing it like a bank does, but somehow now I'm going to benefit from that. I guess before we dig too far deep into this, let's define our terms here. So we're talking about an overfunded cash value life insurance policy. They're not all created equal. You can't just go down to your local New York Life guy and get one. You have to be a specialist to know how to design these things to work properly. So tell us a little bit like exactly what it is and how it works. And then we can dive into some of the nuances of it.
Absolutely. So I think the first premise people need to understand, just so we can start at like brass tacks, and when you're sitting across an insurance professional or financial professional that wants to talk to you about this, if you understand this macro concept, everything else will flow from this, which is you need capital throughout your life. You're either going to be using someone else's or you're going to be using on yours. Now, if you're using someone else's, my capital is earning interest. But if I'm using somebody else's, then I'm paying interest. And that's how the world works. This is what helps you, I think, not only structure your policy correctly, utilize it correctly by being an honest banker. And then one other kind of macro concept is banks are doing this all the time already. That's why Nelson's book is called Becoming Your Own Banker, because you're doing the same thing they do. You're keeping money in motion, lending it out, and getting the interest off of it. So what you first need to do is find a life insurance company, not any life insurance company, a mutually owned, dividend-paying life insurance company, not State Farm, not Allstate.
Are there 5 or 6 of them that do these types?
There's about 6 of them right now because they're consolidating. So there's, and I can go through the names if you want me to. But anyways, you need one of those companies. And these companies typically have something like 100+ year history. So we're not going to have to worry about them going away. And then the key thing is to take out a policy, which you're entering a contract with the life insurance company. And the key thing here is that you own the policy. The owner is the one that controls the cash. You don't have to be the insured because you might have some type of thing that happened to you back in the past and nobody wants to insure you. All you need is to be owning on the policy, and you can do all the things that we're about to talk about. And the key here is when you take out the policy, you want to, because you said something earlier that I wanted to double click on, which was these are heavily commissioned products. Not necessarily.
Right.
Because what happens is the policy typically has 3 parts. It's the base, which covers your death benefit. And this has to be big enough so that this does not turn into a modified endowment contract and treat it like the IRS will tax. So once you figure the base, which you usually need a second part, which is a rider to make this so you can buy basically more insurance on it.
That's a paid up edition?
No, that's not yet. Not yet. That's just I'm going to add the ability to add more insurance just so I can have a good enough foundation to build the policy to overfund it enough.
Okay.
Because if you don't have enough insurance, the rate at which this becomes a mech is when you're dumping too much money in and the policy base is not wide enough. And the way you can make the policy base wide enough without paying too much money is add on like a term rider that falls off later. So now you've got 2 parts. And then the last part is the crucial part, is the paid up additions.
Okay.
That's when you dump money in as much as you can up into what they call the MEC limit, the modified endowment contract limit. So that money that comes in almost becomes immediate, if you structure it right, almost comes immediately cash value to you. Like for instance, my break-even point for most of my policies are around the 6th or 7th year. So that when I'm putting in $1, I'm getting more than $1 out. Right? For the first 2-3 years, you're going to probably put $1 in. You're going to have access to 60 to 70% of that. You can do some 90-10 stuff, but there's some nuance with how you structure that stuff. But that's the basis of this. And what you'll find out is the commission part, the heavily commissioned part is the base part.
Okay.
But if you structure a policy to most of it being paid up addition, then the commission kind of levels out.
Okay.
Actually.
Yeah. That's so often the thing that people tell me, oh, they're just there to get you commissions. I like to be very transparent with revenue models because I want to create a win-win. And so if somebody's coming in and they're making it sound like they're just doing me a huge favor, it may be cynical, but tell me what's in it for you so that I can figure out how we can craft this into a win. I don't think it's cynical. I just want to know how the revenue model works because a lot of people just leave that out. They talk about all benefits to me, which we're told to do in our marketing. Talk how it benefits them. But then you get this kind of untrustworthy period where you're not talking about how it benefits you. Like with my fund, I help investors put money into my fund. We loan it out to house flippers or use it to buy commercial properties. And then they make money, which sounds great. At one point, like, why are you doing this? Time consuming. It was expensive to set up. What are you getting out of it? When I can tell them what I'm getting out of it, they can go into it with their eyes wide open and say, okay, now I know everybody's hand who's in this bucket, who's getting fed how, and it makes it easier to make good decisions. So that's why
we're all grown folks here, right? You get to make a good business decision whether you want to do business with me or not. I would say one last parenthetical on the commission is this is how I knew that the company I was working with didn't know what they were talking about. So I'm working on a policy for the biggest client I have. His premium's like total, all 3 of those parts is like $140,000 a year. It's not a slouch premium.
Yeah.
And so when they structured it first for me to vet them and see what they were talking about, I saw that they put like all of the premium, basically all that 140 into the base, because as my broker, they got an override from all the production I got. And so they were trying to heavily weight that to how they got compensated. And I was like, no, we're not going to structure like we only want 20% base and we want 80 in PUA. That's what we want. And that totally changed the commission picture. And they were like, are you sure you want to do it like this? This is not the way to do it. And I was like, okay, you don't know what you're talking about then. That's how I knew.
Yeah.
Because his motive was, and I was like, no, I'm trying to create a family bank for my client so that he can basically start drawing down retirement income tax-free 10 years earlier than he wanted to retire. Like, this is like a linchpin, the whole financial plan I had. So that's where I knew, but this only came through after I knew how to structure these policies. I made my own, I used it, and I was like, that's not right. So there's some nuances to this, and it's so important that you work with somebody that knows how to do this if you don't feel like going down the rabbit hole of all the knowledge that it takes to do this. But yeah, that's how you structure one.
Yeah. And I think that it can get, like you said, complicated and nuanced. And so choosing somebody who can write these policies that they can be used for the way that they're intended to be used is really important. There's a high degree of trust there because most of us barely can even read the documents when they come back. And needing to be a more informed consumer so that when you send me something back, I can say, this is what I'm looking for. This is not what I'm looking for. What are some of those questions that we should be asking to find a provider who does know what they're doing, is going to structure the policy to our benefit primarily, and then they should be getting paid to do that. But I want to make sure that the customer priority comes first, and then the seller priority is secondary. It's still a win at that, but making sure, like you said, can you imagine getting a policy that's supposed to be used in a certain way and then to find out you can't use it how you thought you could? Like that to me. So what red flags are they looking for when they're choosing a provider? And then after that, go a little bit more into the modified endowment, a contract, the NEC, because we get a little lazy and we don't manage our policy correctly. And we'll get a letter saying if we don't XYZ pay this loan pay or whatever, it's going to turn into a modified endowment contract and it's no longer going to be considered like this tax rate. I don't even know. I don't remember what they're talking about. So give us some red flags, some questions we should ask for, some green flags when we're looking for a policy designer, and then how we maintain that policy to make sure it wasn't created as a mech or it doesn't turn into a mech due to mismanagement.
Yep. Great stuff. Okay. So if you're sitting and listening to this and you're like, this sounds pretty good, I think I want to go down this path, how would I start? The first thing I would do if I'm going to work with somebody, and I'm sorry, this is just Dominique and I'm old school and I believe in eating my own cooking. If you're trying to sell me a policy, you don't have one, red flag. I'm sorry. It just, you're not selling with conviction, but it's, dude, like you don't really know how this works because you haven't done it. And I'm just old school like that. Now, some people may shot me down on that, but that's my first one. Do you have one? How many of these have you done? That's the first one. The second, like, red flag is, and now I have to give you the companies that do this, and I might miss a couple, but I'll hit most of them. If you're not writing this with Penn Mutual, Lafayette Life, One America, Guardian, maybe Mass Mutual, and I know I'm missing one, but there's only 6. If somebody's, I can structure this with State Farm, or I can structure this with Mutual Omaha, or no, you can't. No, you cannot. The other thing that is super important here, and this is a matter of philosophy, but I'm gonna explain myself. If somebody's trying to do this with an IUL, red flags should go up. And here's the reason why, is because, and I'm trying to see how to keep this like elementary level versus like college graduate. There are 2 chassis on which you can really do this. And they're both permanent policies. One is an index universal life. One is a whole life policy. Now, the problem with, in my opinion, an index universal life for what we're talking about, let's call this a 50-year-old man with 7-figure net worth that's trying to do this. I believe that through real estate and traditional asset classes, he can access the market all he wants for a whole lot cheaper than doing it through an IUL. That's it. Like the whole point of this guaranteed structure, and I can use that term pretty loosely and confidently, because a whole life policy is guaranteed.
Yep.
If you structure this thing, I have a policy that I wrote for a client where it will we're going to overfund it for 10 years, and it's going to create so much cash value that it pays the dividends until they die.
Yep.
So all they got to do is just overfund it for the first 10 years.
Mm-hmm.
It guaranteed. It's not going anywhere. IUL based on market performance. It is what it is.
Yeah.
And here's another thing. IUL strategies, the option buying strategies, and I may be getting some terms that I need to define, but option buying strategies that fund or that push these IUL policies have only been around since the late 90s. We don't even have a good enough track record for them. But when they're projecting, it's going to be like 8% or 12% returns. Really?
Yeah.
Okay. I hope so. With the life insurance company, we have a guaranteed 3 to 4. And then with these dividend paying ones that have been paying dividends for 150 years, like Penn Mutual, we already know we're going to get on top of the third guaranteed 3 or 4 stated rate. We're going to get that, what this in the illustration, that non-guaranteed just means now we're adding in the dividend, which we don't know. We declare it every year based on how many people die versus how much premiums we got in. So they don't know. That's why it's non-guaranteed. But we already know it's going to be 2 to 3%. So I'm probably going to get 6% uninterrupted compounding as long as I hold the policy. So this is the reason why I choose whole life over IUL. If somebody's trying to write you a family bank policy or the IUL, I need to ask more questions.
Yeah.
I need to ask more questions. What else would I say? I would say, how long they've been doing it? Do they have their own? How many have they written? Is it IUL or cash value life? I think those are good starters.
Okay.
Those are really great starter questions.
Yeah.
Now the MEC stuff. So this is what will cause. So first of all, when this is being structured properly, there are red flags, if you will, in the system, to overuse that term. There are red flags in my illustration software that will show me if you structure it this way, it's going to MEC out at this year.
Yeah.
So we need to ask for the full illustration.
Okay.
Because there's footnotes on there that says there's typically 3 perspectives for the illustration. The first illustration is going to be like the basic ledger, like just the basic thing. The next one's going to be if we have these, what they call supplemental rates, if the policy performs really well. Usually you get like a base case, a mid case, and then a worse or a best case type of deal. So those 3 are what you're getting. And if the policy is going to MEC based on how they structured it, it'll give a footnote in the illustration software that it's going to MEC. So your professional just needs to share that with you. That's what needs to happen. Now, after that's done and it doesn't MEC, the only other way that this is going to happen is this, let's say, policy to accumulate X amount of cash value, but then you borrowed against it and you didn't pay back that loan. And so the structure in the policy, let's say, to have the cash value be accumulating and maybe pay some of the dividends down like I had, but you borrowed against it, that's not good anymore if you didn't pay back the loan. And so that might that might throw off the policy too. So there's a couple of ways to happen, but the fail safe, if you will, is to run the original illustration that does not MEC at all.
Okay.
And that's how you want to do it.
So a modified endowment contract is basically a cash value life insurance that has too much cash in it. And so it's permanently denied the tax benefits. That was one of the reasons that we got it. And usually for us, it's just a couple $100. It's you're off by $200, send us a $200 check. And after, if you don't do that within 90 days or however long they give us, it'll turn into a MEC. Now, I think this is another, if we want to go back to what we were talking about before, another thing that this kind of policy had a bad reputation for a while because people were overfunding, stuffing money into it as a money laundering technique.
It would be 80s, yes.
Yeah, so
legislation is not that old.
Well, so the MEC is really important because it's how they were fighting the money laundering that was going on, just hiding all this money in this judgment-proof tax-free thing. So can you give us a little bit of that history so that we can see like how the product became legitimized after these designations and these caps and these limits were created?
I'm going to give a book recommendation. Everybody should read Garrett Gunderson's What Would the Rockefellers Do? Everybody should read that because basically what you'll find out, the history of this is that Walt Disney used his cash value life insurance, open up his first theme park. That's how old this stuff is. It's probably older than that, but that's one that I know of. And so for years, wealthy families and those that knew about this were taking money that they had that could go into other taxed vehicles. They were stuffing them into cash value life insurance policy. I think R. Nelson Nash, before he died in 2016, he had 22 policies.
Okay.
People they were stuffing money into this thing. Now, Congress decided that, as they do all the time, this is being used as an investment vehicle. We can't tax it because it is a contract. Like these contracts existed before the IRS code was created. So the IRS code came afterwards to try to get remunerated from all the things that were happening in these policies. And so in 80s, I forgot exactly, there's a tax code exactly for this. There's 2 tax codes, and I don't know them off the top of my head. But they came around in the 80s, and they basically said that if, in fact, you are using this as an investment, then it's going to be taxed like an investment, like a 401k. All the things pop in, 59 and a half, penalty, all those things pop in, and it looks just like an investment. So it's very important. Can't underscore this enough, that if you go through all this and you don't structure it properly and it becomes a MEC, and once a MEC, always a MEC. You can't reverse it. It's irrevocable.
Yeah.
Then you've just wasted all that. And there's sometimes, depending on your net worth, this still could be a viable strategy, even if it becomes a MEC, because there's still the flow of funds, meaning that this first in, first out, or last in, first out, how that the basis is treated. There's still a way that you can take money out. You may not do loans, you may do cash withdrawals and things like that. So there's some nuance. All is not lost if your policies met, is basically what I'm saying. But you do lose a lot of the features that people originally designed these policies for.
Okay, so I'm not sure if we really covered this back at the beginning. So let's bust it back down to, correct, what are the benefits and features of the policy? Why would anybody want this? And I'll ask it in this way. Why would I put my own money in there just to borrow my own money back? And so what is the benefit of the policy? Why would anybody want to consider getting one of these?
Yeah, there's so many ways I can go with this. I'm trying to think of the most salacious way.
Oh, we can YouTube.
The math they don't teach you in grade school,
Yeah.
is that you could borrow at 6 and earn 4 and still come out ahead. I know they're kind of mind blowing.
That's why I'm saying we need a refresher course, because when we got ours, I feel like I understood it better. And now I feel like, oh, we must be doing it wrong, that we're getting these MEC notifications, and we must be doing it wrong because it's like when we get money, we're not paying back the loan. We go and invest it in something else. And I think I've lost my way a little bit. And sometimes
let me break it down to it. So let's say you have a car loan, right? You have a car loan, traditional finance at 6%. Whatever your note is, we're just making these numbers up. You borrow $25,000, 6% is probably going to be something like almost $500 a month. When that car loan is, if you look at the amortization schedule and you see what your payment's made up of, is principal and interest. And if you notice, in that first 12 months, 13, 14 months,
interest,
there's a lot of interest.
Amortized interest.
Yes.
That sucks.
And what happens over time is what the interest gets smaller, but your note stays the same. This math is much different than uninterrupted compounding on a smaller number, say 4%. So and it's so weird if you just do the math. I'm going to give your audience access to some videos that I created around this that will illustrate this. And when you see it on paper, you're like, oh my gosh, this is crazy. I can loan money at 6 and I can pay 4 and come out ahead. Oh, wait a minute. I might as well be the bank then if I'm going to do that.
Yes.
And this is the reason why you would borrow the insurance company's money at simple interest, which is a better deal.
Yeah.
Right. My policy right now will charge me, I think, 6.2%. It's simple interest. So like I can pay, and I don't want to get too nuanced, but like basically, as long as I pay my premium and as long as I pay my interest, simple interest on my loan, I'm good to go. The policies, they don't care what I do with that money. Right. And at the same time, the money that I deposited with them in my PUA and overfunding it is earning at this point 6%, 585. Uninterrupted compounding, just sitting on deposit with them. That's the reason why I would borrow. Even people are looking at that arbitrage of whatever, 35 basis points. The reality, though, is if you're paying yourself back, honestly, like a banker, like if you was going to borrow that money out in the real world, you would have to pay back principal and interest. Do the same to yourself, and you'll see that your policy will overperform. Yeah. That's what you will see. And I know the math is hard because in school, they didn't teach us that. But that is the math. And the numbers don't lie. The numbers do not lie.
I figured it as part of my velocity banking strategy, because to me, velocity banking is the difference between amortized compound interest versus simple interest. And I remember my sister's daughter actually called me years ago about, she needed to buy a car and she wanted to get a car loan. And she wanted to know like the Dave Ramsey way or the has Emma learned and changed her mind kind of way. So we talked about velocity banking and being able to pay for the car and getting a more of a simple interest, like
Mhm.
actually even putting it on a credit card that she had a low, like at 0%. And we talk about that a lot. It's funny because now my sister has her own infinite banking policy and a HELOC
Oh,
on her house where she's treating those simple interest vehicles. And the way that we talked about it, she says it's like temperatures in Celsius and temperatures in Fahrenheit. These are not the same. We see a percentage,
ooh,
5% and 14%. And we think it's the same because it's percent, but it's not the same thing. It's two different ways of calculating interest. And so a 6% simple rate is not the same as a 6% compound rate. And so once I got my head wrapped around velocity banking and simple versus compound interest, that's when things really started to flow for me because I put my own money in and I'm going to
mhm.
borrow it back out as simple interest. And then I'm going to go invest in something else that does better than what I'm paying on the loan. And so it's almost like now I'm getting a high heels of the investment. So if I'm doing a 10 to 12% hard money loan, because a lot of my real estate investor friends would be like, why are you doing 10% or 12% hard money loans? Why can't you go out and do something that's 14, 15%? I'm like, hard money is very low risk. And
Yeah,
because I've used the money to go and invest into the hard money loan from my policy, borrowed it from my policy, it now bumps that interest rate up a little bit, just enough that makes it like now I'm getting a lower risk product for similar types of results that I'm going to get on a lot of equity investments. So for me, that was what really
yeah,
exploded the whole thing. And all the tax benefits and the judgment free and all that, it's completely, those are almost like side perks. But understanding
yeah.
simple and compound interest to me is the key. I don't know. What do you think about that? Is that a good way to think about it or?
I love that idea because what people don't realize is banks tell us to do things that actually they do the opposite of.
Yep.
They tell us to come save our money, deposit it in the bank, and as soon as we put our money there, for every $10 that we put there, they're able to loan out 9 because
Yeah.
of fractional reserve banking. And they pay us back in the day. They pay us now something higher, but let's just say they pay us 1% back on your money. Not too long ago, there was 1% on your cash. But then they sit out there and go loan my money out at 6 for somebody's HELOC and 3 for a car loan. And you add all these things up and you're like, okay, so they loaned net my money out at 6% and they paid me 1, they made 5. No, that's not how it works. The difference between whatever they loaned out their HELOC at 6 to my 1 was 5. And then they did a home loan at 5% to my 1, which was 4. So that's 5 plus 4, that's 9 already.
Mhm.
That's how they make their money. And why wouldn't you want to do what they're doing?
Yeah.
Like that's what blew my mind. I was like, "Oh my gosh." When they loan out the $10 out of deposit and keep 1, and just think about it, people. Why can there be a bank run? There's only the only reason why there can be a bank run is because there's not enough money in the bank.
Yeah. You got to get the
So
first.
it's out on loan. And as soon as you can start to think about how this really flows and the capital seeks its highest return and money needs to stay in motion,
Yeah.
the more you open your minds to this and the blinders will come off and you'd be like, oh my gosh. And this is another thing too, and I don't know if your audience wants to know this or not, but so go look on a bank's balance sheet. Just look, at Citibank, Bank of America, anywhere. So you're going to see the money that they make on these loans. And one of their biggest assets is not stuff in the stock market. It is bank on life insurance. That's what it is.
Yes. Yes.
Banks on life.
That was one thing I didn't know when I first started talking about this. I got another sister story. I have a lot of sisters and a lot of brothers. You're listening to this, they'll know who I'm talking about, but nobody else listening would know because there's so many of us that gets
Yeah.
my sister, my brother, and it could be and any number of people. But she was telling my brother about it and was trying to explain it to him. And her husband was like, "No, I don't want one of those. That's not math." And my brother somehow turned around and he's, "No, that actually is math." And he started explaining it to her from this what you just said, because it's how banks make money. And he was like, "Yeah, actually that makes total sense." And so he was able to get his head wrapped around it even from her more inexperienced explanation of it. And when he basically was able to explain it back to her to how he figured it out, I was like, yeah, that actually makes a lot of sense. And so just being able to think about it in the terms that simple compound interest, the way that banks, the velocity of money, all of that going around, and that's what really unlocked. And then tell us about, so I have 3 questions.
Okay.
Tell us about the tax benefits. Tell us
Okay.
about the judgment or the legal protections that money in there provides.
Mhm.
And then tell us about, I don't know, I forgot the third one. Tell us about those 2 and I'll remember the third one later.
So this becomes, I've started using it as a way to save on taxes
Get it.
for a lot of different reasons. You put money into a contract, it's already been taxed.
Very kind of.
Yeah. As long as it doesn't become a mech,
Mhm.
then when you pull it out as a loan or withdrawal, and you get to withdraw your basis first. So first in, first out. So I put $5 million into a policy or $500,000 into the policy. I get to draw that out before I draw out the dividends.
Okay, so just like taking an owner's draw from a business where the draws are less than the owner's contributions that you already put in.
Yep.
Yeah.
So there is no taxation on it. And even when I die, my heirs get the death benefit tax-free. So for all those particular reasons is the reason why the MEC law is now in force, is because it's like, nobody in, never have to pay taxes, never again, right?
They're
So,
like, let's put limits on who can contribute to a Roth and how much they can put in because this is such a good product. So yeah, here's what you
you
want
think
to
about this compared to a traditional 401k, where, and I got this really great video that your audience will get access to. When the nominal rate on your 401k is like 7%, once you deduct all the fees and the taxes, it becomes something like 4%.
Okay.
And so it's a video that I like, really mind blowing when I did the math on this. So it's like when you think about a pre-tax typical 401k where everybody puts all their money in, it's trillions of dollars in 401ks. All you're doing is letting that money grow to share a bigger slice with the government. What you're doing. And so all that growth you get to share versus something like this. If I stuff my money in this as opposed to a 401k, that really grows at 6% compounded, let's just say, and I pull it out and it's all mine.
Yeah.
So it's a no-brainer. I got a couple clients that are got some pretty good 35% tax bracket because of how much money they make. And being even over 50, it's just a drop in the bucket, which you can put in your 401k, even a Roth 401k. From a tax standpoint, this becomes one of those extra vehicles that I've been using. Actually, overfund your policy. You don't need it. Let it grow for another 15 years, like you did your 401k anyways.
Mm-hmm.
And now we're looking at 1K. It's got a $2 million cash hoard that you can do loans and whatnot off of. It's a no-brainer.
Yeah.
So
After 5, 6, 7 years, depending on how it's structured, like you said, you put $1 in, you're going to get more than $1 out. To me, it's once you let the policy mature, which we're not very good at because we've got the biggest policies that we could possibly qualify for. It's a lot of money that has to go in there every year for us to maintain it. And we borrow it back out way before we're supposed to. So we're really slowing down the maturation of the policy because we need that money to be invested in better stuff because we're still building. But at a certain point, I've always say when we get to our foundation where we've got actual $2 million cash invested, that's cash flowing, not just equity out there, that the policies then I think will become even more important to us when we have our basic cash flow needs met a little bit better. And then I'm starting to see like the vision and the beauty of being able to stuff more money in or get new policies when that we have so much money coming in that we can meet those premiums, not the premiums, what do you call it? The maximum contributions per year. Because my husband's is paid up. We don't have to put any more money in that, but we can put more money into it every year. So when that money's going in easily every year and we still have money left over, that's when I think we'll really start to benefit from these. Right now, I don't think they're that useful because we keep borrowing them out and we keep slowing down.
Well, and you think about it from there, you just alluded to something that one of my mentors said is actually after, Nelson Nash talks about this in his book, a good family bank takes about 10 years to build.
Okay.
And so you have to start thinking about it from the standpoint that once you've done the discipline of funding it, at the 10-year mark is when you actually shift. It becomes the bank. It's almost like, let's say I make 150 grand a year. My 150 grand, actually, I need to structure it to go into a policy.
Okay.
And then I need to borrow out what I need. There's so many ways that I've seen people do this where they borrow the equity out of their home through a HELOC, and they might live off of that. And then their paycheck goes into their policy, right? Those type of things. So that's when you're trying to really accelerate things, right? And, you have a whole lot of different nuances and moving around and kids and all the things. It's easier at a later stage in life. But I would say typically it takes about 10 years. The other question was creditor protection. So in the event of bankruptcy, contractual law is contractual law. This is between you and the life insurance company. So these assets are protected inside of that policy between you and the insurance company. Now, I'm not a lawyer and an attorney. So if you start to be like, hey, I want to do this in a holding company with an LLC, hey, I don't know about all that. I just know Dominique Henderson with Penn Mutual, like that is protected from creditors in bankruptcy. You start to get all wonky with your business structure and stuff like that, you probably need to consult an attorney.
Yeah. I'll give a couple of caveats that I can't remember the third thing. It doesn't matter. You remember the second thing, and that shows you have a better memory than I do. But
I wrote it down. So.
One of the things I noticed is you have to like your agent as a human being because that's your
Literally.
agent for the life of the policy. As long as that agent is alive and you are alive, you
Yeah.
are in business together. So I definitely have realized that as we have our long-term maintenance on our policy, that every time we have to talk to our agent about something, whether you like them or don't like them, it actually becomes pretty important as the policy matures. Are they going to spend
Mhm.
time with you when you forget why you did this in the first place and you need a refresher course? If you're using it wrong, every time I get something that says, hey, you didn't do this right, it's going to turn into a Mac. I need to keep refreshing how this works and make sure I'm using it properly. And I really like one of my agents who, when I said, hey, are we ready for another policy? He said, no, you need to do X, Y, and Z first. So he could have sold me another one at that point if he told me yes. But his honesty, and I would maybe tested him a little bit, his honesty and his ease of being able to communicate with him kind of told me that we were doing it right. And so that's one thing. You really got to like your agent a lot. And the other thing about it is you just have to think about like the long-term game and being patient in this thing. Because I think people, when they first find out about it, their jaws drop and they're like, they think it's going to be this get rich quick thing, but it really is not. It's a tool that should be added that can accelerate our wealth and accelerate our growth. But it just like real estate takes a while to get up. Do you have customers or clients of yours who, when you first tell them, their minds are blown and then they're like, oh, wait, this is going to take a little while?
Blown, I think, because this is not because it's maybe it is novel, but it's the opposite of what we've been taught, to be quite
Mhm.
honest. That's why I think people react this way.
Mhm.
I don't write policies for people that do not read
Yeah.
one of the two rules. I just
Take
Google.
investors who don't read either.
Yeah, I like, look, so they go, this is great. How do I get started? Okay, first thing you need to do is either, I forgot the other one I used to do, Banker Yourself by Pam Yellen. It's a watered down version of that, but I stick to now the R. Nelson Nash, Becoming Your Own Banker. And there's another one, The Beginnings of IBC or something like that, R.
Mhm.
Nelson Nash. If they don't read one of those three, there's nothing to do
Okay.
because this is not a hands off strategy.
Exactly.
Right? You,
I've
me
learned
and you
art.
are partners. Yeah, we're partners. And, and if I am not servicing the policy, if I'm not running enforced illustrations, if I'm not letting you know that, hey, you just took out a loan, don't forget to pay your interest. That, if I'm not doing that kind of stuff, then what am I doing? And if you're not being honest, like what I've done for all my clients that take out loans from their policies is I created a spreadsheet, and I'll probably have somebody on Fiverr redo it, but
Yeah.
basically, yes, spreadsheet. So if I borrow this and the rate is this from me borrowing from the company, and I want to pay myself back X%, this is how much I should be starting to put in my own family bank. Because the way I do it is I say, okay, you're going to borrow a loan, borrow money from out of your policy. Great. Open up a totally new bank account. And in that bank account, the only flows are the loan from the insurance company when you borrow the money,
Mhm.
the money you paid back to yourself being an honest banker, and the money you paid back to them in interest and principal.
Okay.
And that way it made so simple, whatever's left over there, profit for you
Yeah.
as a banker. So don't mix it with the rest of your stuff. I've seen that too. And I was like, that's just a disaster waiting to happen. And so what we have is my little spreadsheet that gives you like the first 3 years of payments on whatever you're financing, and you can figure that out. And all you need to do, and I just have to set up an automatic withdrawal to just pay yourself that. And then since it's simple interest, you're only paying that once a year,
Mhm.
make that odds to them, pay your premium, and then all that stuff is just left in there, and that's your profit.
Yep.
So you gotta be willing to do a little bit more rolling up your sleeves with this. It's not just like a regular term policy or just
Yeah.
something, well, forget it. It's not that at all.
If you're going to use it as a financial vehicle or financial tool rather than just a death benefit, yeah, you have to like know how to use it. It's like getting a checking and savings account and then never doing anything really and actually use it. I think that is a misunderstanding. A lot of people get the policy that if you are going to be borrowing and paying and all that, it does take a certain degree of maintenance and monitoring and self-awareness to know, like with me, wait a second, I forgot what this was again. I'll call my agent and be like, did you reread the Nelson Nash? He's always told me that. The other thing I think that needs to be mentioned, maybe we don't need to dwell on it too much, but if you have a self-directed IRA and you want to take the money out of your IRA and you want to go invest it in something where you have control over what it's invested in, 90-something% of that is invested in real estate. That's really what the self-directed IRA is for. But they always tell you, you cannot invest in the collectibles as well, and you cannot invest in a life insurance policy, a cash value life insurance policy. And so people will take their money out of their IRA, buy a policy, and then go invest. That'll burn all of the tax benefits there. So why is that? Why is that not okay in your self-directed IRA?
Yeah. So I may be a little over my skis here with that because I remember the self-directed some of the stuff. So, but basically, the same group of people, Congress,
Yes.
created the self-directed IRA rules.
True.
So let me give you a better way to look at that. Let's say you got $1 million IRA and you got an LLC. Now, let me go back a little bit. This is not financial advice. Consult your financial advisor.
Even if you are a certified financial planner, you will never certified financial planner.
I don't know about your situation, but I think what you could do alternatively is take your IRA that you have, let's say $1 million IRA, you got all kinds of stuff in there. It doesn't have to be in cash, whatever. You got an LLC. You have a legitimate business. Open up a solo 401k. Dump your IRA, how much ever you want into it. Could be the whole thing, into the solo 401k.
Mhm.
Now what you have is the ability to take loans against your 401k. Just like you can take a loan when you're working for an employer from your 401k and take the loan and use that to fund your life insurance policy.
So that's one.
That's a better way to do that.
That's one of the questions you can ask. My attorney did an episode with me recently on one of our webinars, and he said people come to me with all this crazy TikTok stuff, and they're like, "Oh, get a trust to put your house and rent it back." That's not a thing. So just your financial advice off of TikTok. So that's the disclaimer. Like, this is something that you can go ask your certified financial planner about, or if you hire Dominique to be your planner, that no one will laugh at you for asking this versus that trust thing where the lawyers are all just, oh, that's not a real thing. But
there's a lot of bad advice on TikTok.
Yeah.
There's mostly bad advice on TikTok.
All right. So I don't even think we're going to get to the point of the show where I ask you about like your future plans and your future dreams and your own passive income journey. So we'll have to have you back like in a couple of months where we can talk about more like your own journey as a certified financial planner, knowing what you know. And this being one tool in your toolbox, there are so many other tools in your toolbox that we can be talking about and your own personal goals. So I'm just going to ask the last question before we wrap up, and then we'll help people figure out how to get a hold of you. Let's talk about the concept of the family bank that you're talking about. So you're like, be your own bank, right? But to me, a family bank means that everybody in my family has a policy, and that we create a family office out of where we have professionals who help us manage our family wealth. And then as each one of us dies, that money, that death benefit goes to the LLC, the family company, instead of beneficiaries to my kids who can go out and spend it however they want. And that way it has to run through the advisors who help us manage our wealth versus just being a beneficiary. Am I thinking about a family office correctly, or the family bank correctly using that? Or could you maybe shine a little bit more light, some more nuance onto that? Or
Well, I think you're spot on.
I don't love
You
a
just
family
explain-
bank.
You just explain the family office. It's exactly what the Rockefellers did, right?
Mhm.
When I call it family bank, it's just like a term of endearment. But infinite bank, private bank, any mechanism by which I am now in an agreement and a written contract with the life insurance company where I am leveraging the cash value of my policy to finance my life, basically.
Okay.
And I like the approach that you talked about because and this is into something that, from a mission standpoint, which is the reason why instead of building a really big firm, I just decided to start sharing this knowledge with financial professionals that want to get in the industry or already in the industry so that it can be more effective and we can reach more people that way, which means this concept of generational wealth, right? So if you have a term policy, then if you outlive the term and something happens to you, like your health changes or get older, it usually becomes cost prohibitive. But if you think about this, and when I told my kids about this, we all started going down that path because the cheapest life insurance is going to be is when you're younger.
Yep.
It just is what it is. And if you can
get a policy on your kid.
You can put aside the discipline to put this together. What you have is a guaranteed way to transfer wealth to the next generation. Now, to your point, instead of just making them beneficiaries, you need to educate them on the effectiveness of keeping this going and what it can be used for. You definitely have to do that as a parent or as a grandparent or whoever you're putting policies on. But yeah, this is the idea of the family bank, keeping the money in the family, the generational wealth. And depending on how much wealth we're talking about, you might need to bring in, and I would highly advise that you bring in other professionals, tax professionals, legal professionals, financial professionals, to make sure you preserve it. Because as it has always been said, it's not necessarily about how much you make, it's about how much you keep.
Yeah.
There's been a lot of people that have died intestate and just jacked up estate plans, and a lot of their money just goes to the government and goes to all these other places.
Yep.
So that's the importance of this. But no, your terminology and vernacular is right on.
Okay, perfect. Yeah. But I didn't really used to care about legacy. When I first started in real estate, I heard people talking about it a lot. Like, this is their goal to be able to, like, pass down the stuff to my children. Like, they need to go earn it, because it's like winning the lottery at that point. They haven't been educated. They don't know how to use it. It's not going to be a blessing to them. Because in my old life, where most of my friends were net worth under $1 million, they would get an inheritance. And they'd say, I can finally go start that business. And they'd go start the business, take on a bunch of additional debt. The business would go under, and then they wasted their inheritance. And now they're in debt. They're like, that inheritance was the worst thing that ever happened to me. So this is the kind of stuff as a suburban kind of, we're wealthy enough to get an inheritance, but not really wealthy enough that we've been taught how to use any of this. So I did not care about legacy wealth. And I have 6 kids, and I'm like, even the thought that I could create enough wealth that each kid, that I could even give them any inheritance, much less so much of inheritance that it wouldn't be a blessing for them. I was just like, whatever, I'm living life. I'm going to die with 0 and this whole attitude. But then my dad died and didn't do it right. And he created a trust, some legal Zoom, and he didn't title anything into the trust. The trust was really weird. After he died, we took it to our attorney, all the siblings to the attorney. And the attorney said, getting a trust done by a professional costs the same as running this estate through probate. It's like, what? Why when we were trying to pinch pennies and we almost had to go through probate? He was able to untangle it after the fact. But that taught me so much, that experience. And I wasn't even the executor of the estate. Like, I was pretty shielded from most of that. And it taught me so much. And then the next thing that I think really got me was when I started buying mom and pop real estate. And I'd have somebody come to me and say, hey, my grandma died. We don't know what to do with her apartment building. Can we sell it to you, or can you help us buy it and we'll partner with you? And getting in and seeing those apartment buildings that were just being totally mismanaged by the executor or the family. And that happens enough times. And you realize this is not a blessing to these children. This is not a blessing to this estate. I don't want to pass any of this stuff down. But at the same time, thinking, what if I just structured it differently and created a family office and a family bank? And then there are people here who will help with this stuff. It's almost like at a certain point, the wealth is a curse because you're saddled with this bad trust that wasn't handled correctly, or this inheritance that wasn't a blessing, or this apartment building that you're running into the ground. And then you get past that threshold where suddenly now the wealth can be a blessing because you can afford to put together a good family office and a family bank. And as we've passed that threshold, or we're getting there, starting to think more about setting this up, my impression and my feelings on legacy wealth have completely changed. And I look back at the stuff I used to say, and all of that's still true, but it doesn't apply anymore. And these concepts that you're teaching, especially getting a policy on everybody, so as each person dies, that goes back into the family office. That's really.
Experience will change that for you. And I think the other thing too is, and you've alluded to it, you didn't exactly say it, but you've alluded to it, is education.
Yeah.
Right. Those taught and bought lessons, those are so key. In a lot of this, I think I've seen so many estates gone awry. I've seen really great intentions. I get older clients that come through and go, yeah, because I want to be able to give the kids the house. I'm like, well, have you asked the kids if they want the house?
Yeah.
That's the first question.
That's the stuff. We didn't want any of this stuff. They thought stuff that they thought we wanted, we just didn't want. I've had to look at the legacy as the education rather than the money and the stuff. Yeah, you see this all the time.
Yeah, education is huge. So I just helped put together an estate plan, and clients making some last minute changes on it. Dean, one, do an estate plan. Absolutely.
Yes.
I'm not going to go there with that. But the point is, after you do the plan, talk to the people about it. You got to educate them. To make a plan and don't educate your family, you won't be here to hear them argue, but they'll be arguing.
Yeah.
It's 2 parts. It's always 2 parts. And that's a whole nother podcast. But I think that it's huge what you're talking about.
It's a side benefit of the type of policy, because if you're using it as a financial vehicle while we're alive to put money in, borrow money out, improve our investments, these are living benefits with the taxes and the judgment, all that. But sometimes we forget that it's a life insurance policy and there's a death benefit attached to it. If it's structured properly, then your family will be coming into some money after you die. And you need to think about how that's going to be managed after the fact so that it is a blessing to them and not a curse. So I think that most of us who are on the pursuit of financial freedom, passive income, we start to get to that point where we realize we want to think through this stuff so that we are leaving our kids in a better situation. Because that's, to me, it's almost just selfish on my part if I just die with zero. And the book Die with Zero, that's not even what it's about. It's about the opposite of that. If you haven't read it, you hear that I'm going to die with zero. Kids are going to be left alone. It's just not something that a loving parent or grandparent does.
I don't know. I'm on board with that idea. I think even just biblically, I don't know where people stand on this, but it's like a good man leaves an inheritance to his children's children.
Yeah.
That's my grandchildren.
Yeah. Just do it right.
Yeah.
The estate plan costs the same as probate fees. And the money gets in and the stuff gets into their hands a lot faster.
Yeah.
A lot more privacy. So just do it right. This can be an awesome tool. Dominique, thank you so much for coming. I always ask how people can get a hold of you, but also why should people get a hold of you after the show?
Yeah. If you're sitting out there and you're like, dude, this conversation is probably the best thing I learned since grade school. If you're sitting out there and you're thinking that, I'm happy to have a conversation with you. I alluded to this a couple times during the interview. There are a few videos on my website that I've created that kind of walk you through not only what I'm talking about now and expanding, double clicking on some of that stuff, but my awakening moment, what I talked about on here, but what I did. Like I got radical. Like I talked about some of the story, but I wrote a memo to my clients and apologized. I did the whole name. If you text, and we'll give you all this information. If you text Be the Bank, 3 words, to 214-239-3722, I'll send you all that stuff.
Okay.
Watch it to your heart's glory. And if it makes sense for us to have a conversation after that, you'll see how to get in contact with me. There's a big button on the page and you can schedule a discovery appointment and we'll go from there.
Yeah. Awesome. I love the free gift. So that I always say that before people invest with me, they should stalk me online. Like I put out a podcast it's on YouTube, it's on a whole platform.
I was walked.
Blog, a website. I'm very active on LinkedIn. Do not schedule a call with me until you are ready to actually get the deals in your email inbox. Like, just do not even go. Stalk me online first, and then if you want to reach out to me, you can do that. Investwithemma.com.
Yeah.
And then we can have the conversation. So I really do love that model because it allows people to learn more about not only the product, but more about you before they take that step of like booking a phone call and having that conversation. The conversations are extremely important. Nothing gets done without that conversation, but we understand you have a choice of who you invest with and who you hire and who you work with. And we want to be one of the considerations. And we don't really just want to spam your inbox with a bunch of stuff that you guys don't want. So
no, I actually pay for my text messages. So if I don't have to send an extra one, that's cool.
And we'll be more careful about what you get. Awesome. All right. Thank you so much for coming on, for educating us. Again, I would love to have you back in a few months to talk more about your personal journey with the financial freedom and passive income and what you've learned from your richest clients. And so that'll be like a little, what do you call it?
A real bonus.
Yeah, a bonus and a preview. And I would also love to talk more about just the FINRA certification, accreditation, raising capital, all the kind of stuff that you are advising your clients on. Would love you to kind of open our eyes up to that whole world that there's more going on there than I realized. I try to get on the broker-dealer website to find some registered investment advisors that I could talk to about, do your clients want to invest in our stuff? I didn't even know what I was reading. I was like, I don't even know how to have a conversation with this person.
It's a very fun exercise. So I could even, I have there's a way if we could finagle on the next one, a screen share.
Oh,
that when you're just, let's say, Tom Jones investment advisor and you're trying to vet him, oh man, I can take your audience down the rabbit hole on what you should be looking for.
Oh, yes.
There was a real estate Ponzi scheme not too long ago in Georgia, and I posted about it on LinkedIn. And so I walked people through on how you could have avoided this. So we could do something like that for your audience too.
Yes, I do have an episode where we have a fraud prevention and fraud detection specialist who walks us through some process, like in one of my most popular episodes ever, because people want what we're talking about, but there's that fear of getting scammed. So I think that's really useful information. And
cool.
Yes, we can definitely do a screen share. My sister told me once, here's a YouTube. You got a LinkedIn tip at the beginning. Here's a YouTube tip at the end if you're a podcaster. She has a podcast that she really likes to listen to on her earbuds while she's out, like taking a walk or a hike or something. And they'll say, if you're watching on YouTube, the diagram says this and this. She's like, now I got to go watch it on YouTube. And it's brilliant. They give me log in and watch their YouTube channel. So we'll do some screen share so people have to get on YouTube to watch.
Yeah, absolutely. I love that.
Subscribe there. So appreciate it. really looking forward to it. You're just a wealth of knowledge, and I really enjoyed this conversation, and I hope the listener enjoyed the conversation too. We're going to put that text number on the screen again. It comes along, or investwithemma.com. We would love to have a conversation with you about helping you become wealthier so you can plan your own passive income adventures. Until next time, see you next week.